Bitcoin's record high, technical analysis and market dynamics. The rise of Bitcoin to $107,000 marks a pivotal moment in the history of the digital asset. This price not only represents a break from traditional valuation metrics, but also reflects a confluence of macroeconomic trends, institutional adoption, and evolving narratives about Bitcoin's role in the global financial system. The cryptocurrency's performance underscores its emerging status as a digital store of value, an inflation hedge, and a speculative asset with unparalleled liquidity. This article analyzes the factors driving Bitcoin's price surge, assesses the risks involved, and predicts future trends in the cryptocurrency landscape. 1. Market context and dynamics. Global liquidity conditions have become an important factor influencing Bitcoin's valuation. The Federal Reserve's continued quantitative easing has reduced borrowing costs and boosted risk appetite across financial markets. Where a weakening US dollar, exacerbated by successive rate cuts, has increased the appeal of Bitcoin as a hedge against fiat currency depreciation. Increased global liquidity. Central banks have injected liquidity into the global economy, allowing institutional and retail investors to allocate significant resources to alternative assets like Bitcoin. Bitcoin's deflationary supply dynamics, capped at 21 million coins, are in stark contrast to fiat systems that are susceptible to inflationary pressures, further increasing Bitcoin's appeal during periods of expansionary monetary policy. Institutional investments led by companies like MicroStrategy underscore growing confidence in Bitcoin as a long-term asset. CEO Michael Saylor's strategy of leveraging the company's balance sheet to buy Bitcoin has changed the narrative around crypto investments. MicroStrategy's increased average purchase price from $30,000 to $61,000 demonstrates unwavering confidence in Bitcoin's potential. Taking on large amounts of debt to finance Bitcoin acquisitions increases risk, as a downward price correction could trigger chain liquidations that impact the broader market. Institutional confidence, while a double-edged sword, has the potential to cement Bitcoin's role as a corporate reserve. However, this trend underscores the need for risk management strategies to mitigate leverage-induced vulnerabilities. 2. Price volatility and market sentiment. Bitcoin's rise from $70,000 to $107,000 in a matter of months has broken psychological barriers, reinforcing bullish sentiment. Key support levels at $100,000 have established a solid foothold, while a break above $105,000 has further fueled speculative interest. A metric such as the Relative Strength Index, RSI, indicate overbought conditions, although this is typical during parabolic rallies. A high trading volumes confirm strong market participation, alleviating concerns about price manipulation. Volatility, while often seen as a downside to Bitcoin, also represents an opportunity. A high price volatility allows traders to capitalize on intraday swings. Excessive leverage by traders and institutions creates systemic risk during adjustment. Despite the possibility of a temporary pullback, Bitcoin's trend remains strong. Consolidation at higher levels would signal healthy price action and prepare the market for future moves. 3. Altcoin market and ecosystem expansion. While Bitcoin remains the market leader, altcoins like Ethereum, Solana, and XRP have demonstrated notable performance. Ethereum's ecosystem growth, as the backbone of decentralized finance, DeFi, and non-fungible tokens, NFTs, Ethereum continues to attract capital inflows. A high throughput and low transaction costs make Solana a preferred platform for developers. The resurgence of NFTs, led by projects like Pudgy Penguins, illustrates the growing utility of digital assets. Meanwhile, meme coins like Shiba Inu have reignited speculative mania. Innovation in tokenomics. Projects integrating NFTs with proprietary chains create robust ecosystems, increasing user engagement. These speculative assets remain highly risky and should be evaluated with caution. The diversification of use cases, from gaming to DeFi, strengthens the crypto ecosystem. However, sustainable growth requires regulatory clarity and technological innovation. 4. Regulatory environment, challenges and opportunities. The U.S. Securities and Exchange Commission, SEC, has increased its scrutiny of cryptocurrency projects, targeting those it deems to be non-compliant with securities laws. For example, Cyberkongs, an NFT project with a token component, has faced regulatory challenges. Misinterpretations of smart contracts and token offerings complicate compliance. The outcomes of these cases will shape the regulatory landscape for blockchain technology and digital assets. Countries such as El Salvador and the UAE continue to adopt crypto-friendly policies, in contrast to the SEC's cautious approach. As competition for innovation intensifies, jurisdictions with clear frameworks are likely to attract talent and capital. The Biden administration's stance on crypto regulation and its successors' policies will significantly impact the U.S.'s ability to compete in blockchain innovation. Streamlined regulations could drive broader institutional adoption. 5. Emerging trends in payments. Stablecoins, such as USDT and USDC, are revolutionizing digital payments by bridging the gap between the fiat and crypto ecosystems. High-speed, seamless transactions and low fees make stablecoins attractive to both merchants and consumers. The concerns about Know Your Customer, KYC, and anti-money laundering, AML, compliance hinder broader adoption. Stablecoins are well-positioned to disrupt traditional payment systems, especially as merchants look for alternatives to intermediaries like PayPal and Stripe, which are prone to account freezes and high fees. As regulatory transparency improves, stablecoins could become a dominant medium of exchange, facilitating global trade and increasing financial inclusion. 6. Countering future technological risks. Quantum computing poses potential threats to current cryptographic standards. Bitcoin's reliance on SHA-256 encryption highlights the need for proactive measures. Bitcoin's open-source nature allows the community to develop quantum-resistant algorithms. Legacy, fragmented, and outdated banking infrastructures are much less resilient. Bitcoin's decentralized governance and adaptability provide a distinct advantage over traditional financial systems in addressing emerging threats. 7. Navigating the market cycle. Bitcoin's market cycle, driven by halving events, provides a framework for understanding price behavior. The current phase fits into a euphoric phase, characterized by rapid price increases and increased speculative activity. The previous cycles suggest the market is likely to peak in mid-2025, followed by a period of consolidation or decline. Gradual profit-taking strategies can protect against sudden downturns. Fear-based narratives often emerge during periods of volatility. Strategies to mitigate FUD include: investors benefit from understanding market fundamentals. Reducing exposure to a single asset reduces market-specific risks. While Bitcoin remains the cornerstone asset, diversifying into altcoins and stablecoins provides a balanced approach to navigating market volatility. Bitcoin's rise to $107,000 is not only a milestone, but also a testament to its resilience and adaptability. Its role as a hedge against inflation, a speculative asset, and a transformative financial instrument continues to expand. However, many challenges remain, from regulatory oversight to technological threats. As Bitcoin and the broader cryptocurrency market evolve, stakeholders must balance optimism with caution, leveraging data-driven strategies to capitalize on opportunities while minimizing risks. The future of finance is being rewritten, and Bitcoin is leading the way.